Today I will be speaking about the village investors, growth in Tier 2 and Tier 3 cities. In the past, most financial investments in India were concentrated in big metropolitan cities, such as Mumbai, Delhi, and Bengaluru. Investors from these major cities dominated stock markets, mutual funds, and other financial instruments. However, in recent years we have witnessed a major shift. Increasingly, people from Tier 2 and Tier 3 cities and even villages are participating in financial markets. This growing participation of small-town investors is transforming the Indian investment landscape. In this presentation, I will explain what Tier 2 and Tier 3 cities are, why investment participation is growing in these areas, the role of technology and financial awareness, the impact of this trend on the Indian economy. 2. Understanding Tier 2 and Tier 3 cities. Cities are often classified based on population, infrastructure, and economic development. Tier 1 cities are large metropolitan areas with strong economic activity. Examples include Mumbai and Delhi. Tier 2 cities are medium-sized cities that are developing rapidly, such as Pune, Indore, and Jaipur. Tier 3 cities and towns are smaller urban centers or semi-rural areas with smaller populations but growing economic potential. In recent years, these regions have experienced improvements in education, infrastructure, and internet connectivity. As a result, more people from these areas are exploring financial investment opportunities. 3. Rise of village and small-town investors. Earlier, many people in villages and small towns preferred traditional investments such as gold, land and property, savings and banks. While these options are still popular, awareness about financial markets is increasing. Today, many individuals from smaller towns are investing in stocks, mutual funds, systematic investment plans, SIPs, digital investment platforms. This shift indicates a major transformation in the investment culture of India. 4. Role of technology and digital platforms. One of the biggest reasons for the growth of village investors is the expansion of digital technology. With the spread of smartphones and internet connectivity, people can now invest easily using mobile applications. Platforms such as Zerodha, Grow, and Upstocks allow users to open accounts and invest directly from their phones. These platforms provide easy access to stock markets, educational resources for beginners, simple investment tools. Because of these digital platforms, investing is no longer limited to big cities. 5. Government initiatives promoting financial inclusion. Government policies have also played an important role in encouraging investment participation. Programs such as the Pradhan Mantri Jan Dhan Yojana have helped millions of people open bank accounts and become part of the formal financial system. Digital payment platforms like Unified Payments Interface (UPI) have made financial transactions easier and faster. These initiatives have increased financial literacy and encourage people from rural areas to explore new investment opportunities. 6. Growth of mutual fund investments. Mutual funds have become one of the most popular investment options among small-town investors. Organizations like the Association of Mutual Funds in India promote awareness campaigns to educate people about the benefits of mutual fund investing. Systematic investment plans, commonly known as SIPs, allow investors to invest small amounts regularly. This makes investing accessible even for individuals with limited income. As a result, participation from Tier 2 and Tier 3 cities in mutual funds has increased significantly. 7. Economic and social factors driving investment. Several economic and social changes have contributed to the rise of village investors. 1. Rising income levels. Economic growth in smaller cities has increased employment opportunities and income levels. With higher disposable income, people are able to invest more. 2. Financial awareness. Educational programs, social media, and financial influencers have increased awareness about investing. People are now more informed about the importance of wealth creation. 3. Youth participation. Young individuals in smaller cities are more open to digital technologies and financial markets. Many young investors start investing early to achieve long-term financial goals. 8. Impact on the Indian financial market. The growth of investors from Tier 2 and Tier 3 cities is having a significant impact on financial markets. 1. Increased market participation. More investors mean higher liquidity and stronger market activity. Stock exchanges like the National Stock Exchange of India are seeing increasing participation from smaller cities. 2. Balanced economic growth. When investment opportunities spread beyond major cities, economic growth becomes more balanced across regions. 3. Strengthening financial inclusion. Greater participation in financial markets helps more people become financially secure and independent. 9. Challenges faced by village investors. Despite this growth, village investors still face some challenges. 1. Lack of financial knowledge. Some investors may not fully understand the risks associated with stock markets. Without proper education, they may make poor investment decisions. 2. Market volatility. Stock markets can fluctuate significantly, which may discourage new investors. 3. Risk of misinformation. Social media sometimes spreads incorrect financial advice, which can lead to losses. Therefore, proper financial education and reliable information are very important. 10. Future outlook. The future of village investors in India looks very promising, with continued improvements in internet connectivity, financial literacy, digital investment platforms. More people from rural and semi-urban areas will participate in financial markets.